So how can you determine when a recession will occur? This year could potentially offer a once-in-a-lifetime opportunity to amass wealth, as current circumstances may provide one of the simplest avenues to significantly increase your net worth, provided you possess the expertise to seize it. While this notion might sound pessimistic, recessions are commonplace, and if handled adeptly, they can offer remarkable opportunities and discounts with the potential to secure your financial future. Warren Buffett has been quoted as saying that bad news is an investor's best friend. In this video, we will delve into the intricacies of recessionary periods, explore strategies to identify their onset, and outline actionable steps to prosper financially amidst the challenges they present. A recession is characterized by a myriad of economic indicators signaling a contraction in economic activity. These indicators include a decline in gross domestic product, GDP growth, decreased consumer spending, plummeting corporate earnings, and widespread layoffs. The onset of a recession is officially declared when GDP contracts for 2 consecutive quarters or more, ushering in a period of financial strain and uncertainty. However, it's important to recognize that recessions also mark the beginning of a recovery phase, presenting astute investors with opportunities for strategic investment. One of the most crucial aspects of navigating a recession successfully is timing. As the renowned investor Warren Buffett advises, be fearful when others are greedy and greedy when others are fearful. This principle underscores the importance of identifying market bottoms and capitalizing on undervalued assets before they rebound. History has shown that some of the most successful investors have seized opportunities during economic downturns, positioning themselves for significant gains in the long term. We observe that they employed this strategy in 2020, 2008, and 2001. This approach of investing significantly during times of economic weakness has proven immensely successful for them. During a recession, several key aspects must be considered when seeking out investment opportunities in companies. Firstly, the downturn often results in a decrease in stock prices, making previously expensive companies more affordable, even after a substantial decline of up to 30%. This presents an opportunity for investors to acquire shares at a discounted rate, potentially yielding significant returns in the long term. Moreover, the landscape of competition shifts during recessions as companies become more risk-averse, creating openings for new competitors to enter the market. This increased competition fosters innovation and drives companies to adapt and differentiate themselves to survive in a challenging economic environment. Additionally, recessions create fertile ground for smaller companies to flourish. With larger corporations focusing on mitigating losses and minimizing risks, smaller players have the opportunity to capitalize on niche markets or emerging trends, paving the way for their growth and expansion. It's crucial to recognize that while recessions induce market volatility and uncertainty, history has shown that bull markets inevitably follow bear markets. The market has a propensity to recover and grow over time, rewarding patient investors who maintain a long-term perspective. Finally, acting swiftly is paramount when identifying investment opportunities during a recession. However, this can be challenging as recessions are often only confirmed well after they have begun. Therefore, investors must remain vigilant, conduct thorough research, and be prepared to act decisively to capitalize on opportunities before they become apparent to the broader market. Investing in the stock market is not merely about buying shares of companies. It's about strategically selecting companies with a durable competitive advantage, or what Warren Buffett famously calls a moat. In essence, a moat refers to a company's ability to maintain its competitive edge over rivals in the long term, thereby protecting its market share and profitability. Identifying companies with a moat is crucial for investors seeking sustainable returns. Take, for instance, iconic brands like Atari, Motorola, and Snapchat. These companies were pioneers in their respective industries, yet they failed to sustain their success due to a lack of a durable competitive advantage. In contrast, companies like PlayStation, Apple, and Meta have established formidable moats, making it challenging for competitors to replicate their success. So how can investors identify companies with a moat? One key aspect to consider is financial performance metrics, such as revenue, earnings per share, free cash flow, and equity. Companies with consistent revenue growth, high profitability, and strong cash flows often possess a competitive advantage that sets them apart from their peers. Moreover, patience is paramount when investing in companies with a moat. While it may seem tempting to chase after the latest hot stock or sell when prices dip, successful investors understand the value of long-term thinking. By maintaining a disciplined approach and focusing on the fundamentals of the business, investors can weather short-term market fluctuations and reap the rewards of compounding over time. Consider the example of Amazon. Despite trading at what may have seemed like an expensive price a decade ago, investors who had the patience to hold on to their shares have seen their investments grow exponentially. This underscores the importance of staying invested and resisting the urge to cash out prematurely. Ultimately, if nothing fundamentally changes with a company's business model or competitive position, investors should refrain from selling their shares. Instead, they should trust in the company's ability to compound value over time and hold on for the long term. Only sell these companies if you completely step out of the investing market. In this video, we have focused primarily on the stock market. The stock market, often perceived as a volatile arena during recessions, can actually be a goldmine for savvy investors. While many individuals rush to invest when the market is booming, experts understand that the real opportunities lie in times of downturn. It's all about psychology, understanding that the dip in the market presents the best entry point for investment. Implementing a 90-10 formula can be a game changer. Allocate 90% of your budget to index funds and ETFs, which offer broad market exposure and stability. The remaining 10% can be dedicated to more high-risk, long-term investments in small, undervalued companies. This balanced approach ensures a diversified portfolio and positions you to capitalize on the market's recovery with potentially significant returns. However, besides the stock market, there are two great ways of growing wealth during a recession. Recessions are not just times of financial hardship, they're also periods of immense opportunity for entrepreneurs. In fact, statistics show that 47% of millionaires are business owners. During a recession, those who have managed to preserve their capital possess a distinct advantage. With reduced competition and increased bargaining power, entrepreneurs can negotiate favorable deals and secure valuable resources at lower costs. Additionally, with ample liquidity, businesses can seize growth opportunities, expand their market presence, and outmaneuver their competitors. In essence, the recession becomes a springboard for ambitious entrepreneurs to propel their ventures to new heights. And secondly, while the real estate market may experience turbulence during recessions, it also presents unparalleled opportunities for strategic investment. The key is to navigate through the initial challenges, such as financing constraints and market uncertainty. Once these hurdles are overcome, investing in real estate can be incredibly lucrative. During recessions, there's often more pressure on sellers, leading to a decrease in property prices and a less competitive marketplace. This creates favorable conditions for investors to acquire properties at discounted rates and build a diverse real estate portfolio. Moreover, storytelling becomes crucial in marketing properties effectively as investors capitalize on narratives that resonate with buyers' emotions and aspirations. By strategically investing in real estate during a recession, individuals can secure long-term wealth and capitalize on the market's eventual recovery. And there you have it, folks. Remember, think bright and happy investing.